Welcome to the Deep Dive. We're here to cut through the noise and really focus on the crucial market insights you need.
That's right.
Today, we're diving into the market landscape as we head into September 2025. It's complex.
Yeah.
Our goal here is simple. Give you a shortcut to understanding what's going on. Where are the opportunities? Where are the risks? We're drawing from a great conversation on Stock Charts TV with Dave Keller and Grayson Rose, looking at the charts they think matter most right now.
And it's fascinating, isn't it? There's this real tension. You've got some genuinely strong signals over here,
Right.
but then some pretty clear warnings over there.
Yeah.
It makes for a really dynamic picture.
Okay, let's unpack that. So, coming into September, the general feeling among strategists, well, it isn't exactly euphoric.
No, not at all.
The summary seems to be not great. It feels like a different kind of discussion than we were having just a few months back, mainly because of shifts in breadth and momentum.
Yeah, absolutely. If you think back to, say, April through May, June, July, that was a really robust market, wasn't it?
Oh, yeah.
You had strong leadership, especially from growth stocks. Participation was broad, good breadth. Momentum was building. All the classic stuff you like to see in a healthy bull run.
But here's where it gets interesting, right? That picture started changing. July, August, now early September. Strategists are pointing to three things they often see at major market tops. First, breadth weakens fewer stocks. Fewer stocks are actually going up.
Right, less participation.
Second, momentum weakens less buying power coming in. And third, leadership rotates those stocks that were leading start to, struggle.
Exactly. And look, from a pure trend-following viewpoint, the overall trend is technically still positive. Lots of indexes are still grinding higher.
Sure.
But because conditions look so similar to previous tops, strategists are drawing some pretty clear lines in the sand, things they're watching very closely.
There's this quick exercise they do, just rapidly scrolling through index charts, S&P 100, 500, the mid-cap 400, small-cap 600, Russell 1000, 2000.
Yep, the simple checklist.
And asking, is it working, struggling, failing? And the thing is, from that trend perspective, most are still technically working. Above moving averages, higher highs, higher lows.
But that, and this is a significant but, the NASDAQ 100 is kind of the odd one out here.
Ah, yes, the growth leaders.
Right. Your NVIDIAs, your Broadcoms. That index didn't make a new all-time high at the end of August. The S&P did, others did, but not the NASDAQ 100. So that makes you question the sustainability, doesn't it, if the leaders aren't leading anymore?
It does, though the counterpoint that came up was the Russell 2000 small caps, mid caps, they're actually starting to, play a bit of catch up.
That's true. It does provide a bit of an offset, seeing strength there.
Yeah, it kind of balances out that NASDAQ weakness a bit.
But this brings us to September itself. And the big elephant in the room, seasonal weakness.
Right. September's reputation.
Yeah, no matter how you slice it, last 50 years, 20 years, post-COVID, election years, September is almost always the worst, or certainly one of the worst months for the S&P 500.
And August was weirdly strong, wasn't it? Given its own weaker seasonal tendency.
Exactly. And Dave Keller actually mentioned that scares some strategists. It's like, stretching a slinky further and further.
Yeah.
Eventually it has to snap back.
Feels like we're definitely at an interesting point. So with all that background tension, let's dig into some specific charts. These really show the opportunities and risks playing out. And fitting that theme of rotation, let's start with a controversial one, NVIDIA. NVDA.
Controversial is right.
Strategists are actually talking about it as a short idea, which sounds crazy given how strong it's been.
It does. I mean, it's been the poster child. But the chart, it shows what they call a significant change of character.
Okay. How so?
Well, it's below its 21-day EMA now. That's often an initial stop level for traders. And crucially, it's below its 50-day moving average for the first time since early May.
Wow. Okay.
Plus, momentum looks, frankly, disastrous. Every new high since late June came with weaker momentum readings. That's a classic bearish divergence. And its relative performance is weakened, too.
So even if you're a long-term bull on NVIDIA, there might be a short-term play here.
Potentially. One strategist laid out a target around 150, maybe 145. That lines up with a 38.2% Fibonacci retracement of that big April to July rally.
Okay, so a technical pullback level?
Right, and it's near the 200-day moving average, too. So
Yeah.
even playing for just a retest like that could offer, maybe a 12, 18% gain on the short side.
What about volume, that big rally?
That's the other fascinating thing. That whole crazy rally happened on surprisingly low volume. Very few above average volume days. Now, some volume indicators, accumulation distribution, Chaikin money flow, they still look okay, actually.
Hmm.
But if you see a spike in volume on a down day, that could be the nail in the coffin for a breakdown.
Okay, so that's a potential short. But where's the new strength emerging? One area popping up on scans for new highs is financials.
Yes, financials have been showing up consistently. Let's look at the S&P Bank ETF, KBE.
Okay.
The pretty classic breakout pattern. It's worked its way back up to the highs from late 2024. Moving averages look good, generally in the right order. Momentum is strong. Relative strength is starting to pick up, which is notable in a market that was all about growth.
And another name mentioned was American Express, AXP.
Yeah, AXP looks like it's setting up quite nicely. It's got this cup and handle pattern forming.
A classic bullish pattern.
Very classic. It's close to confirming, needs to break above $330. And importantly, it doesn't have those bearish divergences we see elsewhere, like in NVIDIA.
There was also this idea that maybe ongoing deregulation could be a tailwind for banks,
Like
right?
that was mentioned, yeah. A potential fundamental driver.
But with AXP, if it breaks out above 330, it might look pretty stretched, far from its moving averages. How do you handle that entry?
That's a really common issue. The approach suggested is lading in. You don't have to jump in with your full position immediately.
Right, scale in.
Exactly. Maybe take a partial position on the breakout itself. Then look to add more on any pullbacks, perhaps down to the 21-day EMA. You don't have to be all in or all out.
Makes sense. And this really underscores the value of just doing those daily scans, right? Seeing what sectors keep popping up.
Absolutely. As Christopher Ron put it, how bearish do you really want to be if financials look this good? It suggests they might be taking over that leadership role from tech.
Okay, let's shift gears again. Home builders. The XHB ETF. These were pretty terrible earlier this year.
Oh yeah, awful.
But now they're starting to work again, outperforming, relative strength improving, pushing to new highs, even testing the 20-day moving average as support.
Yeah, definite improvement there. A lot of individual home builder stocks are getting back above their 200-day moving averages.
And the thinking here is tied to interest rates, maybe.
That's the connection, yeah. If rates potentially start coming down, that's a big tailwind. Makes homes more affordable, more accessible.
Good point. And if you're choosing between similar ETFs like XHB versus ITB, it's worth checking out sites like ETF.com, right? Compare holdings, expenses, liquidity.
Definitely. Always good to know what you're actually buying.
Okay, another area showing emerging strength. Motorola Solutions, MSI.
Yeah, MSI feels similar to the home builder story. It's an area that's just starting to, emerge from the background.
How's the chart look?
It broke above its 200-day back in early August. Then it had this really nice orderly pullback to its rising 21-day EMA,
Textbook.
pretty much.
Yeah.
And now it's rotating higher again. You see higher highs, higher lows, momentum improving, relative strength improving. Ticks a lot of boxes.
And this is where that history of winning idea comes in, right? You check the long-term chart.
Exactly, like a 5-year weekly chart. You want to see that the daily breakout is happening within a nice established uptrend, not just a bounce in a long-term downtrend.
And MSI is a good example of that.
Perfect example. It's been in a beautiful long-term uptrend.
What about RSI? Is it getting overbought?
It might be getting up there, but remember, overbought means up a lot.
Yeah.
In strong long-term uptrends, stocks live in overbought territory.
Right.
You actually worry more when a stock makes a new high, but the RSI isn't overbought, like we saw with NVIDIA. That suggests the buying power isn't really there.
Got it. Okay, next up, let's talk crypto, specifically IBIT, the iShares Bitcoin Trust.
Ah, the ETFs making crypto more accessible.
Exactly. It brings it into the traditional equity world. And what I like is seeing the pure supply and demand play out. IBIT looks like it's doing a classic breakout retest and bounce setup right now.
Interesting timing, too, because seasonally, September tends to be pretty weak for Bitcoin itself.
Oh, really?
Yeah, but Q4 tends to be remarkably strong. So maybe some weakness first, then strength. We're also seeing Bitcoin find support around that 5960K level.
Which is significant how?
It lines up with a 38.2% Fibonacci retracement of the rally from the April low to the July peak. It's a key technical level traders watch.
You know, I use this personal system with lines on my charts. Green for entry, red for stops, orange if I'm getting concerned, blue for targets.
A visual plan.
Yeah. With something volatile like IBIT, fixed percentages are tricky, but the lines give me context. I know what an 8% stop means in dollar terms for this position.
That makes sense. Discipline is key.
Yeah.
Okay, let's find another actionable chart. How about healthcare with Merck? MRK.
Merco. Yeah, that's been pretty underwhelming for a while, hasn't it?
Incredibly underwhelming. A big reason, healthcare as a sector has lagged. But something's changed since mid-April.
What's different?
The whole distribution pattern looks different. It's managed to get back above its 50-day moving average. Now, it's still below the 200-day.
Okay.
But if it can break above the 200-day, which would also take it above the highs from April and July, that could be significant. Momentum looks strong, but not, excessively so.
You know what's fun? Hunting for dogi candles on charts, those little indecision candles.
Oh, yes, the spinning tops.
Right. They often mark key levels.
Mm-hmm.
Merck had a really nice dogi back in March, and it lines up almost perfectly with that potential breakout level above the 200-day. It's like a little signpost.
That's a neat observation. Okay, how about a choose your own adventure? Now, within the same sector.
Yeah.
Consumer discretionary.
Love it. What are the options?
Option A is McDonald's, MCD. Option B is Dutch Bros, BROS.
Okay, McDonald's first. That feels like the safer play, right?
Generally, yeah. It's showing a nice breakout. It's trending higher, starting to outperform its sector. Plus, you get a dividend.
Solid.
And technically, there's a lot of meaty price action below the current price to set potential stop levels against. Momentum looks fantastic, too.
Okay, that's option A. What about Dutch Bros? BROS. Feels riskier.
Definitely higher growth, higher risk potential. It's a really interesting name. They smashed earnings recently, and now it's threatening a breakout from its IPO base, that initial trading range after it went public.
But you need to look at multiple time frames here.
Absolutely critical. The daily chart looks good, threatening that breakout.
Yeah.
But zoom out to the weekly chart.
Yeah.
It's been in this really choppy, wide range. Suggests there could be a lot of volatility even if it does break out.
So two very different profiles.
Exactly. Look at the weekly chart side by side. McDonald's, classic blue chip, slow and steady progress. Dutch Bros, recent IPO, coiling up in this pattern, building energy. If it breaks out, it could be incredibly powerful. The weekly momentum oscillator is almost giving a buy signal there.
Fascinating contrast. Okay, where next?
Let's touch on precious metals. Silver XAG. Both silver and gold are breaking out again this week.
Are they acting as safe havens again?
Yeah, be careful with that label. Sometimes they rally with stocks. But right now, the miners look, well, innocent until proven guilty.
Meaning?
Higher highs, higher lows.
Okay.
Above rising moving averages, strong momentum, strong relative performance. They're checking the boxes.
What's a key level to watch?
The 21-day EMA is usually a good initial support level to keep an eye on. I mean, silver miners are up something like 90% year to date. That's huge.
Wow, outpacing a lot of tech.
Absolutely. And the volume indicators look super strong, too.
Yeah, metals can really rip when they get going. You just need solid stops in place. Copper's another one that's been working too, right?
Copper's looking strong, too, yeah. Another commodity play.
Okay, last one for this round. I'm looking at Meta Platforms. Meta feels like a fat pitch AI play.
Fat pitch. Explain.
Well, it's been incredibly strong, especially since the April lows. It's obviously right in the middle of the AI revolution story.
Right.
And technically, it looks like another breakout, retest, bounce setup. Volume declined during the recent pullback, which is good to see. And RSI held above 40.
Yeah, I see that. It fits the description of a fat pitch chart quite well. You've got a strong long-term trend, and you get some short-term weakness.
An opportunity to get in.
Exactly. It's the kind of setup institutions often look for to build positions. Now, you could put on your bearish hat and ask, what if support doesn't hold?
Sure.
But the volume indicators, accumulation distribution, Chaikin money flow, they've actually been improving lately, suggesting some buying is happening into this weakness.
And this is where my lines come in handy again. I can mark my ideal entry, maybe an 8% stop, a wider 12% stop just in case, an orange concern level below the recent low, and maybe a blue target line where I'd consider adding if it confirms strength.
Structures the whole trade plan.
Yeah.
Very disciplined.
So wrapping this all up, what does it mean for you, the listener? It's clearly a dynamic market heading into the fall. There's this tension, right? Underlying strength in the indexes, but these real concerns about leadership, breadth, seasonality.
Definitely.
And we're seeing clear signs of leadership rotation. Money seems to be moving away from just pure growth, finding new homes in financials, industrials, maybe even metals. Technical analysis becomes really vital to navigate this.
Absolutely. The key is having a consistent approach.
Yeah.
Using tools like chart scanning, volume analysis, maybe your personal line strategy. It lets you compare opportunities consistently, make rational decisions when signals conflict. And it highlights finding what you might call technical diversification, looking for different kinds of constructive chart patterns across different sectors, not just chasing the same old leaders.
So the final thought for you to chew on. With all these competing signals, these new potential leaders emerging, what lines in the sand will you be watching? How will you navigate this complex market in the months ahead? We definitely encourage you to apply these ideas to your own watch list and keep digging deeper.